Hello everyone, welcome to Oliveboard. Welcome to the RBI Circular Part 2 of August 2025. So this will be the final video for the August month. Let's start the discussion. Okay. So we have already discussed some of the circulars like co-lending arrangement, INR settlement related, truncation system related, and SRVA account, special rupee was through account related. So in this particular session, the main circular is for basically non-fund based credit facility direction 2025. This will be the very important circular for you guys. This one is not related for you guys. Again, this is certain some of the words are amended here in this particular KYC direction and compliance with the honorable. Again, this particular circular is also not so important for your examination. So the crux here is non-fund based credit facility, and I'll be also covering some of the stuff which was posted on the RBI website. Okay, so let's start with that particular news. So it was a press release which was recently posted on the RBI website on 29th of August 2025. The quarterly basic statistical return. So RBI is basically publishing the quarterly BSR reports. What is BSR? Basic statistical return 1 on credit by scheduled commercial banks for the month of June 2025, right? So in this particular report, it's nothing but a quarterly credit report. We can see that the bank credit growth has decelerated to 9.9% in June 2025. Earlier in June 2024, it used to be 15% and now it has been decelerated to 9.9% in June 2025. So we are doing a year on year basis comparison, right? We are doing a comparison based on year on year basis. So from 15% it's now at 9.9% as of now, right? So one thing that you need to know is 9.9% is the current data. We can see here it's the total line, dotted line is the total line, 9.9%. Plus you need to know that as of now, the highest growth rate is in the personal loans, that blue line which we can see, 12.3%. Blue line, then followed by the industry, and then at the last I can say is the agriculture, right? So the highest one as of now is personal loans. Some of the observation that we can see here now, this particular news is fully loaded with data. We don't have to remember each and every data, right? We can't even remember each and everything. So please do remember, only try to retain the important stuff for your examination. No need to take more and more pressure, right? Just try to only understand that data, only try to remember that data that have a high chance of coming in your examination. Otherwise, there is a lot of data in all the circulars in all the finance current affairs stuff. So here we can see that the personal loans continued to grow at faster than the overall credit rate. So we have seen that the overall credit growth rate is 9.9%, but personal loans are growing at 12.3%, right? Plus their share is also 32% in the total credit rating. So sorry, in the total credit in June 2025. So whatever total credit we are having, a share of 32% is just for the personal loan itself. The public sector banks recorded a higher credit growth. So here can I say that the public sector banks are outperforming the private sector banks in terms of the credit growth, So as of now, the public sector banks are recording a growth rate in the credit of 11%. However, the private sector banks are only recording a growth rate of 8.3%. And then foreign bank last mein aa rahe 8%. Okay. And here we are talking about the first quarter, June 2025. Again, so the BSR1 was related to credit, and now the BSR2 is related to the deposits with the scheduled commercial banks. This is BSR2, which is quarterly basic statistical return 2 for the month of June 2025. Okay. Here we can see that the bank deposit with the scheduled commercial banks have registered a growth rate of 11.3% compared with 11.7% a year ago. So again, we are doing a year on year comparison only. So it's not at all a steep fall is what I can say is just a slight fall. Okay, it's just a slight fall of 0.4% something, 0.4%. Yeah. So as of now, it's 11.3% in June 2025. Here you can see the composition in the bank deposit. So in the bank deposit growth, the highest composition is of the term deposit. You can have a look that 62% of the total deposit is term deposit here, right? Followed by the savings and then the current account at the end. Just 9.5% is the current account, 62.2% is the term deposit. So you need to remember this one, right? Again, it's fully loaded with data, so you don't have to remember each and every data. Okay guys, you don't have to remember each and every data. Okay guys, so the most important circular, Reserve Bank of India non-fund based credit facility direction 2025. Let's start this. Whenever a bank gives you money today and you pay back later, that's a normal loan facility which is called as fund based facility. However, if the bank doesn't give you the money now but promises to pay someone else on behalf of you if needed, that's a non-fund based facility. These can be very important for your examination purpose as well. So we already discussed कि non-fund based facility क्या होता है. These are the banking facilities where the bank does not directly give any kind of cash or loan to the customer, but they are promising to pay on behalf if certain conditions are met. That's why we call it as non-fund based facility. So bank guarantees, letter of credit and co-acceptances can be some of the examples of the non-fund based facility. We'll be definitely having a detailed discussion regarding what bank guarantee is all about, letter of credit क्या होता है and co-acceptance क्या होता है, right? Why the RBI has issued these directions? Obviously, we need a common set of rules as of now for all the regulated entities, and to promote better access to infrastructure funding whenever there is a need of long-term funding needs, right? In that case, we need guarantees. So these long-term projects need bank guarantees, letter of credit in case of a international transaction, and sometimes co-acceptances as well. That's why it will definitely give a better access to the infrastructure funding. Earlier guidelines were scattered, so that's why we need a consolidated guideline here. So that's why this particular direction यहाँ पे publish हुआ है. If we talk about the applicability, this particular direction is applicable to the commercial banks, including the regional rural banks and the local area banks. Primary urban cooperative banks, state and central cooperative banks are also included in the list. All India financial institutions, however, for the fourth pointer, NBFCs and HFCs, but they'll be only covered if they are at least middle layer and above. Okay, that too only for the partial credit enhancement. Now what do you mean by partial credit enhancement? Now, as the name says it all, we are enhancing the credit partially. Okay, so it improves the credit rating of the bond so that the corporate can borrow from the bond market on better terms. Let's suppose there is a corporate entity. They want to issue the bonds and raise money from the market, right? Now they need to improve their credit rating. Let's suppose a bank or a regulated entity has partially given a credit enhancement, right? Has partially given a guarantee to the corporate that in case if you are not able to repay your bond, we'll be definitely repaying it on your behalf if required to a certain partial limit. That's what partial credit enhancement is all about. When a bank or financial institution is backing a corporate entity like this, it will definitely give a good credit rating, right? Credit rating का क्या फर्क पड़ेगा, उससे बढ़ जाएगी credit rating थोड़ी. So here is that's what the meaning of partial credit enhancement is all about. However, you need to know that derivative exposures is in the non-applicability of this particular guideline except the general conditions which are being there in the chapter 2. तो chapter 2 के अंदर जो कुछ conditions है वो apply करेंगी. Otherwise, all the rest of the derivative exposures are not covered in this particular chapter. Effective date आपको पता होनी चाहिए. Financial year, next financial year चालू होने की डेट ही इस सर्कुलर की, इस डायरेक्शन की इफेक्टिव डेट है 1 April 2026, राइट? सो जो भी नॉन फंडिंग फैसिलिटी दी जा रही है आफ्टर दिस डेट और ऑन और आफ्टर दिस डेट, डेफिनेटली वो ये नए गाइडलाइंस के अंदर फॉल करेगी. Now here we can see in the circular as well, partial credit enhancement is the subordinated facility provided in the form of irrevocable contingent line of credit. So यहाँ regulated entity क्या कर रहा है? Irrevocable contingent line of credit दे रहा है. It's a subordinated facility given to the corporate which will be drawn in case of shortfall in case of in the cash flows. Let's suppose there are shortfall in the cash flows of the corporate entity, so they are not able to service their bond, right? So we will be, as regulated entities, we will be servicing their bond, but to a partial limit only, right? पूरा का पूरा हम सर्विस नहीं करने वाले, एक partial limit तक करने वाले हैं. Okay guys, now let's start with the key definitions which are there in the circular. The first one is beneficiary. Let's have a quick reading and then we'll be understanding it. Person or organization in whose favor the NFB facility is issued. So a company receiving a bank guarantee from another company's bank. Let's suppose there are three parties here, A, B and a financial institution which is a bank, right? So here A has given B a loan. Say for example, A has given B a loan. Now A needs a guarantee. So can I say that the financial institution has given a guarantee to Mr. A on behalf of Mr. B? On behalf of Mr. B, this bank has given a guarantee to A. So can I say that A is the beneficiary here? Why? Because any person or organization in whose favor the NFB facility is issued. So a company receiving a bank guarantee, who is receiving the bank guarantee here? A is receiving the bank guarantee from another company's bank here, right? So A here will be the beneficiary. Next is the concept of co-acceptance of bill. Bank promises to pay seller if the buyer fails for the trade bill. So what happens in the trade bill is, let's suppose A has given some goods on credit. A has issued some goods on credit, sold some goods on credit, and B will be paying the money, but after 3 months. After 3 months, B will be paying the money. So here what happens is, now what happens is A needs the money right now. A needs the money right now. So what A can do is, A can draw a bill on the B. A can draw a bill on the B. What B will do is, B will accept it. B will accept it, sign it and accept it. And what A can do is, A can give this bill to the bank and get the money right now. Get the money right now. This is called as bills of exchange or the trade bills. So here the bank is promising to pay the seller if the buyer fails, right, for trade bills. So it's like a backup promise in the trade finance. It's like a backup promise in the trade finance. So what a bank is doing, it's just acting as a co-acceptance of bill. Bank is just giving a guarantee. If the buyer fails, I'll be paying you the money, right? Next is the guarantee definition. So bank agrees to pay if the customer fails to meet the obligation. This is a direct guarantee. This is a direct guarantee. Bank is directly giving a guarantee to pay the customer if the customer fails to meet the obligation. So basically, what's the difference between the co-acceptance of the bill and guarantee? So in co-acceptance, what happened? A bill of exchange is a written order, right? Where the seller is asking the buyer to pay money, pay a certain amount in the near future, maybe after 3 months, right? So the buyer has signed the bill of exchange. B has signed the bill of exchange. That means B has accepted it, right? And the co-acceptance means a bank is also putting the signature. So bank of B is also guaranteeing it by putting the signature along with the buyer, promising Mr. A that if the buyer defaults, bank will be paying the money, right? So it's a kind of backup, I can say. It's a kind of backup in the trade bill arrangement, right? Now, guarantor, the bank that gives the guarantee. Here the bank who is giving the guarantee will be called as the guarantor. And then the obligor, a person whose obligation is being backed by the NFB facility. So whose obligation is this? Mr. B's obligation is this. So Mr. B is the obligor here, right? And again, if the facility is backed by some tangible, then we call it as secured portion. Obviously, whatever we call as secured, that means it is backed by a tangible or a realizable collateral. Now, there are some general conditions in this. I'll definitely tell you what can be important for your examination as well. What are the general conditions in it? RE's credit policy. RE's credit policy must define the type of non-fund based facility. What kind of non-based facilities you are giving? Is it a guarantee? Is it a co-acceptance bill, right? So you need to clearly specify that. You need to clearly specify the limit, security, fraud prevention, monitoring, and the number of times you need to audit the things. So clear cut things should be there in order to enhance the transparency. NFBs are generally given only to the customers who are already having a fund-based facility. Why I will give, let's suppose if I am a bank, why I will give a non-fund-based facility with respect to Mr. B? Because he might be already a customer, right? He might be a customer in my bank. So that's why I'm giving a non-fund based facility. Why? Because I'm already giving a fund based facility to this particular client. Otherwise, why I will engage in such kind of activities, right, of giving a non-fund based facility. Now a regulated entity shall issue NFB facility only behalf of the customer. I can only give NFB non-fund based facility who is a customer, who is my customer. Still, I can give it even if he is not my customer. I can give it in the following cases. In the following cases, it can be derivative contract, it can be partial credit enhancement, right? There are multiple things. You don't have to remember each and everything. You don't have to remember each and everything. Just give it a quick reading and that's it. Okay. So NFB cannot assure repayment of deposit and bond. This is important. NFBs, non-fund based facilities, cannot assure repayment of deposit or bonds unless the RBI specifically allow. Let's suppose a corporate entity is issuing bonds, right? So I am a financial institution. Now I cannot issue NFB for the repayment of this bond or deposit unless the RBI specifically allows. Why? Because generally bonds and these kind of deposits are nothing but money market instruments, right? Bond is a money market instrument. So can I say that who is the money market instrument in India? RBI is the money market instrument. So you cannot back a facility, a bond or deposit facility by a NFB, non-fund based facility. Okay. Unless and until you have taken a permission from the RBI. If a non-fund based facility turns into a fund based facility, how? Let's suppose in the arrangement, bank has given a guarantee that if B is not paying A the money, if B fails to pay A the money, bank will be honoring the obligation, bank will be paying the money to the A. And what happens if actually B doesn't pay the money? In this case, bank is now under an obligation to pay the money to A, right? So here it is written, if the NFB, earlier it was NFB, now if the B is not paying, it has turned into a fund based facility. Right? Now the bank actually needs to pay him the money. So in this case, normal loan classification rules will apply. In this case, normal loan classification, whatever normal loan classification rules you are following, that will apply. Right? That's what is written here in the circular as well. So I have pasted the screenshots as well. If I talk about the guarantee, it can be, it must be, not can be, it must be irrevocable. You are not able to revoke it. Unless, and otherwise what we will do is, पहले आप क्या करोगे, गारंटी दे दोगे, you will be giving the guarantee, then you will be revoking it. It should be unconditional. There should not be any kind of condition attached, right? And it should not be any kind of controversial in nature, or I can say disputed. It should be very, very clear. It should be enforceable in the court of law. So these three things should be there in the guarantee. These three things are a must, right, in a guarantee. If you are giving a guarantee, then these three things are must. Internal limit required, especially for unsecured guarantee. If this is an unsecured guarantee, if you are giving an unsecured guarantee, what do you mean by unsecured guarantee? The loan is not at all secured. The loan is secured by nothing. Obviously, if the loan is not secured, then there are higher chances of default, right? There are higher chances of default. So in the case of smaller banks, it can be UCBs, RRBs, LABs, STCBs and CCBs. The total guarantee should be less than equal to 5% of the total assets. The total guarantee should be less than equal to 5% of the total assets. Please do remember these limit, very, very important. This can be important. The total guarantee should not exceed 5%. Maximum limit is 5%. However, in case of unsecured guarantee, if you have given an unsecured guarantee, in that case, it won't exceed 1.25% of the total assets. So these are the smaller banks, right? So somewhere or the other RBI needs to protect them. That's why they have limited it. In case of total guarantee, should not exceed 5%. The total guarantees should not exceed 5% of the total assets. If it's an unsecured guarantee, it should not exceed 1.25% of the total asset. And if you are already breaching the conditions, you need to comply with these conditions by 1st of April 2027. right? You cannot immediately revoke the guarantee. So that's why RBI has given a timeline. You can follow these rules and regulations till 1st of April 2027. That's what is written here. You can read it later on as well from the circular directly. I have also highlighted the things for you guys. Okay. Next is the electronic guarantees. What are e-guarantees? I have just electronically given the guarantee. However, you can definitely do it, but you need to have a very strict standard operating procedure, right? What is standard operating procedure? Whatever things we are operating, there should be a standard procedure of giving and taking guarantees, right? So SOPs must be clearly defined. System integration and risk controls are already in place. Then only you can use the electronic guarantees. Otherwise, there are quite cases of fraud in this particular area. That's why RBI has specifically stated you can definitely issue the e-guarantees, but you need to follow strict SOPs here. System integration should be very good and risk control should be there so that fraud cases can be minimized here. Then guarantee to the other banks, normally not allowed unless trade guarantee. So what happens here is, let's suppose one bank is giving guarantee to the other bank. What is happening here is, let's suppose a regulated entity like a bank or financial institution, say for example HDFC Bank, right? HDFC Bank is a financial institution. Now it cannot issue guarantee to SBI Bank so that SBI Bank can issue money to Mr. B, issue loans to Mr. B. So bank should not guarantee bank for the repayment of loan, right? It should not ideally be there. So a regulated entity like bank or financial institution should not normally give guarantee to another bank or RE just to help the other bank give to loan to someone else. So SBI Bank wants to give loan to Mr. B. So HDFC Bank is giving guarantee to SBI Bank कि okay मैं बैठा हूँ कोई दिक्कत नहीं है, I am there, you give the loan. That's not permitted. That's not permitted. But if it is a trade transaction, let's suppose this is an importer and exporter transaction and you are giving a letter of credit. You are giving a letter of credit and something like that, right? It's a trade related, then that is permitted. Trade related things are permitted, but non-trade related things here are not permitted. So please do remember, only trade related things are permitted here. This can be important for your examination perspective. Next is the timely payment rule. Now what is timely payment rule? You need to order the guarantee once it's invoked. When it will be invoked? When the borrower fails to deliver the obligation to the lender. Obviously now you need to pay. You as a financial institution, you need to pay the money. So the guarantee is invoked and you need to make the timely payment of it. That's obvious. That's obvious. So as per my understanding, this particular point is very, very important for your examination, right? Okay guys, next is the co-acceptance. Now only genuine trade bills are allowed. Only genuine trade bills are allowed. Ensures that the goods are received in the borrower's stock record. Now let me just first explain it to you guys. What do you mean by genuine trade bill? Okay, what do you mean by genuine trade bill? Now Mr. A is a shopkeeper. Mr. A is a shopkeeper. So what Mr. A did is, he sold goods. He sold goods to Mr. B on credit. So B will be paying him the money after 3 months. Money after 3 months. But what Mr. B did is, he accepted a bill. He accepted a bill, right? Because Mr. B is paying the money after 3 months. So what A did is, A has drawn a bill of exchange. Now B needs to sign it. So B has signed it. B has signed it. Now this is a genuine trade bill. Why? Because goods and services have actually been delivered or rendered, right? Have actually given the goods. This is a genuine trade bill. बिना goods के भी bill बनाया जा सकता है. I'll tell you how, right? Goods have been actually delivered here. Now what is co-acceptance? Now because I'm not sure that whether B will be paying me the money or not, so what I did is, I asked Bank of B, HDFC Bank, to sign this bill as a co-acceptance. So HDFC Bank authorized person has also signed this particular bill. Why? He has given a co-acceptance. In case the B fails to deliver the obligation, HDFC Bank will be delivering the obligation. Now this is a genuine trade bill. How we can understand that whether it's genuine or not? Look, what if definitely A is a shopkeeper. A hasn't given any kind of goods, I can say. A has not supplied any kind of goods, but directly has made an invoice. A dummy invoice, a fake invoice. What if it is a fake invoice of 1 lakh rupee? Right? And on the basis of this invoice, what A is doing is, A is creating a bills of exchange. Right? So on paper, they have created such a kind of transaction that A has sold some goods to B. However, actually, A haven't sold anything. A haven't sold anything to B as of now. Right? Are you guys able to understand it? A has just created a fake invoice that he has sold goods worth rupees 1 lakh to B, and now he is making a bill of exchange. B is signing this bill of exchange, and now what A can do is, A can take immediate cash from any bank by doing the discounting, right? A can give this particular bill to any bank and get it discounted. So this is just done to obtain money from the bank, I can say. Now these kind of bills cannot be co-accepted. Why? Because this is based on the fake invoice, or I can say dummy invoice. This is based on dummy invoice, right? So only genuine trade bills are allowed here. You need to ensure that the goods have been actually received in the borrower's stock record. So this is again important. This is again important for you guys, right? Now RE cannot co-accept if another RE has already funded the trade. If another RE has already funded the trade, let's suppose it's a genuine transaction. A have supplied goods to B. Now these goods have already been funded by a particular bank, let's suppose SBI Bank. So SBI Bank has given an overdraft facility or CC limit to B for buying these goods, right? Now this particular bill which A is making and B is accepting cannot be accepted, cannot be co-accepted by HDFC Bank. It cannot be co-accepted by HDFC Bank. Why? Because already a particular bank has funded the goods, right? So it's a kind of double financing is what I want to say. Already B को SBI से loan मिला हुआ है for buying these goods. Again, HDFC Bank is co-accepting the bill and giving a guarantee that B is not able to pay, then I'll furnish the loan. I'll be paying the loan. That's not permitted. Why? अरे आपको पैसा मिला हुआ तो है SBI Bank से, right? You already have the money from SBI Bank. Why you are co-accepting it again with the HDFC Bank? So that's not permitted, right? Now they have mentioned about requirements of other specific guarantee related to business involving the overseas current and capital account transaction. If there is any overseas current and capital account involved in the transaction, what will be the treatment here? So what is the overseas transaction? Now AD banks, authorized dealer banks, can issue NFB facility in case of overseas current or capital account transaction. Authorized dealer banks can issue the non-fund based facility, right, for legitimate transactions. Obviously, foreign subsidiaries, AD banks can issue guarantees for the foreign entities where the Indian companies hold control. So let's suppose Reliance is having a subsidiary company in UK. What do you mean by subsidiary company? More than 50% of stake is being held with Reliance Industry in terms of equity shares. So this is a subsidiary of Reliance Industry. Now authorized dealer bank can also issue guarantee for the subsidiary, right? Because ultimately it's controlled by Indian entity only. And next is stock and commodity broker. So only the SCBs can issue guarantee for brokers. Why? Because brokers, obviously it's a risk oriented business. So on behalf of the stock brokers, only the scheduled commercial banks can give the guarantee, right? Only the scheduled commercial banks can give the guarantee. Now we have already discussed about the partial credit enhancement. What is the purpose? Basically to improve the credit rating of the bonds, so the corporates can borrow from the bond market on the better terms. So what happens here is, let's suppose I am going to issue a bond. So what if I have a partial credit enhancement from a particular bank? So the bank is guaranteeing that in case I am defaulting on this particular bond, the bank will be bearing X amount of money. The bank is guaranteeing about the around the X amount of money, let's suppose for 5%, right? So in that manner, my credit rating has now improved, right? Why? Because I'm getting a backing from a bank. In case if I default, the bank is liable for that settlement, right? So that's what partial credit enhancement is all about. So key points are, eligible REs are scheduled commercial banks. So RRBs are not at all eligible. AFIs NBFCs, HFCs, middle layer and above the middle layer plus the scheduled commercial banks, these are eligible. Now who can get a partial credit enhancement? So corporates, SPVs, special purpose vehicles, large NBFCs, HFCs having 1000 crore plus assets or municipal corporation, they can get the partial credit enhancement. It's not like that anybody can get a partial credit enhancement, right? Again, it will be a subordinated facility only. It will be irrevocable contingent line, which will be drawn in case of shortfall in cash flows of the servicing bonds. Let's suppose I have issued bonds, but I'm not able to repay that bond. In that manner only, in that case only, the bank will be liable to pay, and that too partially, So partial credit facility is where the bank or financial institutions promises to support the repayment of the bond issued by the company. So I am Prateek Limited, I am a corporate entity, right? I have issued bonds. However, I am not able to repay these bonds because of the cash flow issues, because of the shortfall in the cash flows. I am not having enough cash to settle this bond. So HDFC Bank has given a partial credit enhancement here, facility here, right? So I can easily draw this particular facility. It's just like a CC limit. Understand it like a CC limit only because it's revolving facility again. It's a revolving facility clearly written here, right? I can take again and again. Whenever I am having a cash flow crunch, I can go to HDFC Bank, take the money, repay the bond, right? But partially, not fully. So what is the limit? If you are a single RE, and it doesn't matter if you are a single RE or all the REs combined, maximum 50% of the bond issue size. This is very, very important. So the PCE exposure by single RE shall be 50% of the bond size. It doesn't matter even if you are aggregate exposure of all the RE should also have been capped at 50% of the bond issue size only. So whatever my bond issue size is, up to 50% only it can be funded by PCE. It can be backed up by PCE. Please do remember, very, very important, right? Very, very important. Now you can only use if you are having a shortfall in the cash flow. It's not like a CC limit actually. Okay, you can only use it even only when the cash flow is short at your end, right? And can be revolving also again and again. If you are having the shortfall of cash, you can use it again and again, no problem with that. Bonds must be having a minimum BBB minus credit rating from at least 2 credit rating agencies. So that's the bare minimum rating you should be having, right? That's the bare minimum rating you should be having here. Now here we are having some of the limits as well, like end use restrictions. So for NBFCs and HFCs only to refinance the existing debt, not for the taking the new asset. And what is the exposure limit? PCE, partial credit enhancement to NBFC and HFC should be limited to maximum 1% of the RE's capital fund. Again, you need to remember this one, right? Again, you need to remember this particular one. Okay, so these are the annexures again. Not so important, I can say. It's just general disclosure requirements. So whatever things I have told you can be very, very important. In this particular question, I can say that we have done in the individual videos as well related to the non-fund based facility here, right? So in case of unsecured loan, in case of the unsecured guarantee, how much is the expressed as a percentage, how maximum, what is the maximum allowed outstanding unsecured guarantee that you the smaller banks can give, the smaller institutions can give? That's 1.25%. And do you know about the secured portion? Maximum up to 5%. For unguaranteed, for unsecured guarantee, it's 1.5%, 1.25%, sorry. For unsecured guarantee, it is 1.25%, and for the guaranteed portion, it is 5%, and that too for the smaller banks, right? UCBs, RRBs, and so on. Next, again, is a press release on the RBI website only related to the regulatory sandbox. This is the 5th cohort on the theme neutral. So this is all about exit, right? So in the fixed cohort, which was a theme neutral cohort, multiple entities were selected, and the final entity which is getting an exit here is Indian Bank Digital Infrastructure Company, IBDIC. I have covered this news in the finance current affairs session as well. So again, they are working on some blockchain technology, right? And they are particularly this entity, the product has been found viable, right? The product has been found viable of this particular entity. So that's a press release basically. Next was the performance of private corporate business sector during the Q1 of financial year 2026. So you just have to remember this particular number. The sales of the listed private non-financial company has increased by 5.5%, that too year on year basis during the Q1 of financial year 2026. Earlier it used to be 7.1%, now it is 5.5%. And as of now you can see here that the highest contributing sector here is services, that to non-IT. The first one is non-IT services. The second contributor is services from the IT sector, and the last one is manufacturing. So as I can say, in this chart we can see that the service contribution from the non-IT is as of now 7.5%. However, all the three sectors are on the downtrend only as of now. Okay, there are some other news as well in this particular, there are some other data as well, but I don't suggest you guys to remember each and every data, right? Because we do have a lot of data again. Yeah, so that will be fine. Even if you are able to remember that much of data, it will be completely fine. So guys, the most important thing in today's lecture was RBI's non-fund based facility direction 2025. One question I can think that one question is expected from this particular direction. Okay, so that co-lending direction that we did in the first part, and this particular non-fund based facility direction that we did in today's lecture. Okay guys, and if you are looking for mentorship, then definitely at Oliveboard we have launched a complete course. This is a crash course. The name is crash course, but we are covering each and everything, right? Before your RBI Grade B examination. This is a complete batch for your phase 1 and phase 2. You can check out the course highlight as well. Plus there is 101 mentorship batch as well. You can check out this particular course as well. And you can give a free PYQ as well. So the previous year question paper related to 2024 is freely available on the Oliveboard website. You can go and do the test in an exam oriented manner, right? So thank you so much guys. Bye bye. Take care. See you soon.